Good morning. It's Tuesday, the 25th of June, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. And the take for today. Now, there is no sign of the stock market slowing down, though they are now in what we call a holding pattern till the union budget next month, which may or may not really provide any surprises. Like we discussed earlier, the government is unlikely to roll out any major SOPs, except perhaps for income tax linked and aimed at boosting consumption and demand rather than purchases of shares. Now, the problem, of course, is that the more attractive stock markets look, the more capital they will attract from all over. For instance, the over $14 billion of domestic capital in the last 8 years, or compared to the $5.4 billion of foreign investment. An article in the Business Standard says that India's family offices are now shifting from traditional investments in physical and tangible assets like real estate to investing in technology, healthcare, and retail stocks. The new wave of family offices is investing more in stock markets, including in pre-initial public offer placements and secondary market operations. Of course, family offices, or the corpus that large business families create or put aside for investments, have always invested in general and invested in equities, but the proportion is seemingly rising. In a way, some of that capital is coming back. Some founders and promoters have raised funds by selling their shares in IPOs, while others have made full strategic exits. Now, that's of course good news for them, because in several IPOs, the promoters have cashed out, even if partially, after maybe 10 to 20 years or even more of running their businesses. But the funds, of course, are more likely to go into capital markets rather than, let's say, new factories in the same or even different businesses. There is, of course, a generational shift as well. Ketan Dalal of tax consulting firm Catalyst Advisors told Business Standard that the exits are driven by favorable valuations, of course, and the diminishing stigma associated with selling a family business that's no longer relevant to the next generation. Anyway, many of these family offices have a corpus of about 250 crore rupees and above, or around $30 million. That's the starting point. Of course, many such family offices are also investing outside the country. Once again, there is no problem in all of this. Of course, if there is sufficient fresh investment coming into core job creation in the country. Now, the answer to that, I don't have any data right now, but I'm sure you would agree, is a little mixed. While old entrepreneurs must make way for a new breed of entrepreneurs as they are, India also needs fresh capital that drives job creation, including in areas like manufacturing, small or large. Many mid-sized manufacturing entrepreneurs I meet actually struggle to convince their next generation or children to join their businesses, forget even running them. The fact that doing business is not as easy as we would like to believe it is or touted to makes things worse and can deter the next generation, who also may not want to touch these businesses for other reasons. For example, they might be inclined more towards technology and information technology rather than, let's say, running a textile plant or a garments factory. The constant changes in tax policy and the introduction of new clauses and rules is one deterrent for sure. Everything, of course, does not boil down to tax policies, but the reason many entrepreneurs, including those I've met, themselves discourage their next generation is to avoid the frictions that they've faced in setting up and running their businesses in their heydays. And now on to our top stories and themes for the day. The stock markets continue to trade in a tight range, await fresh global and local triggers. The good and bad news of a front-running investigation on in India's markets right now. A lithium factory catches fire in Korea even as lithium demand continues to fall. Could food inflation come down thanks to lower edible oil prices? And India's tryst with high-speed trains, understanding what they mean and where they're headed.
This is a core report with Govindraj Ethiraj.
Markets await fresh triggers, both global and local. Now, there is a cloud hanging over this market, which is a front-running investigation against one of the smaller mutual funds. Now, that cloud is more to do, I feel, with the stocks in the portfolio and what they mean rather than the fund itself, and details on that coming up shortly. In the markets as a whole, global cues were somewhat subdued and continue to be because, among other things, investors are weighing NVIDIA's valuations on Wall Street very carefully now. NVIDIA is the most expensive stock in the S&P 500 index, with its shares trading roughly 23 times the company's projected sales over the next 12 months. Of course, India is used to much, much higher valuations, but that's another story. Back home, the benchmark indices pulled back from losses in the second half of trade on Monday, June 24th, to end slightly higher, and the BSE Sensex ended with a gain of about 131 points to end at 77,341, while the NSE Nifty50 was up 37 points at 23,538. The BSE MidCap and SmallCap indices were up about 0.3 and 0.2% respectively. Now, the Nifty50 has traded in a 450-point range in the past 10 sessions in the absence of any major triggers, according to analysts who spoke to Reuters. Back on Wall Street, CNBC has pointed out that Wall Street's climb to record highs has come with conspicuously little volatility. The S&P 500 has gone 377 days without a 2.05% sell-off. That's the longest stretch for the benchmark since the great financial crisis, according to FactSet data compiled by CNBC. The index hasn't experienced a gain of at least 2.15% in that time either. And year to date, the S&P 500 is up more than 14%. So all this means is that volatility is low and the climb has been steady. Now, how long this will last, we don't know. Elsewhere, oil prices are still high, relatively so, as the focus is now on high summer demand in the backdrop, of course, of continued geopolitical tensions. Brent crude is quoting around $85.40 a barrel on Monday and was up about 3% last week for its second consecutive weekly gain, according to CNBC. A lithium factory catches fire even as demand crashes. Multiple powerful explosions set a lithium battery factory on fire in South Korea on Monday, killing 22 workers, most of them Chinese nationals, as it burned out of control for nearly 6 hours, fire officials said in a Reuters report. The blaze ripped through a factory run by primary battery manufacturer Airy Cell in Hwaseong, an industrial cluster southwest of the capital Seoul, and was eventually largely extinguished. Amazingly, that news comes on the heels of a report in Bloomberg almost at the same time, which spoke of lithium industry watchers hit by the realization that prices have fallen again this month, with inventories piling up as electric vehicle demand signals stay gloomy, or electric vehicle demand is not picking up as people hoped. Spot prices of lithium carbonate in China have slid to the lowest since August 2021, and the most active futures on the Guangzhou exchange have lost 12% so far this month, said Bloomberg. These declines follow a plunge of more than 80% in 2023 thanks to a glut and slowing demand growth. Although prices stabilized earlier this year, the supply chain is still working to clear inventories, with customers holding off purchases. And the bearish sentiment, according to Bloomberg, is also wreaking havoc on the stock prices of producers like Albemarle and Piedmont Lithium. A mutual fund is rated the good and bad news. Market regulator Securities and Exchange Board of India is investigating Quant Mutual Fund, a domestic mutual fund with about 90,000 crore or around $11 billion in assets under management, for front running. The story, first reported on website Money Control, also spoke of raids by the SEBI in the mutual fund's Mumbai headquarters and Hyderabad premises of suspected beneficiaries. According to the Economic Times, a dealer from a quant entity or a broking firm through which the fund deals is suspected to have made advanced trades based on privileged information. The last time something similar happened involved Axis Mutual Fund, in which SEBI barred the fund's dealer and 20 other entities and also impounded wrongful gains. Now, Quant Mutual Fund will surely see redemption flows from both large and small investors, as is likely or ought to happen at a time like this. But interestingly, the growth of Quant is quite amazing. The Economic Times says Quant Mutual Fund assets were only about 24,000 crores, about $3 billion last year around May. So it's almost tripled in size in a year. In 2019, which is about 5 years ago, it had barely $25 million in assets. So $25 million 5 years ago to about $11 billion today. The fund has done well, with many schemes returning more than 60 and 70% annualized in the last year. But the worrying aspect is that as of March 2024, according to the Money Control, there were 14 companies in which Quant Mutual Fund is the only mutual fund house to have a stake. Now, these companies include names like Century, Enka, Josh Engineering, Lancer Container Lines, Russell India, Sasken Technologies, Ashapura Mindchem, and Nahar Spinning, and there are many more. Now, most of these stocks are actually small holdings, so there's nothing to say that there's something wrong in the stocks or the companies behind them. It's just a little unusual. And of course, also reflects the overall frenzy in the small and mid-cap universe in the last 2 years or so. In some ways, this fund appears to behave like how many smaller investors do, or perhaps it's the other way around. But the larger context is this. A front-running investigation suggests that there was some or suspected malfeasance in the functioning of the market. I actually see it the other way around. It tells me that the market regulator is reasonably responsive and alert, even if this is the outcome of a whistleblower operation. Front-running, by the way, happens in all markets and more so, quite obviously, in bull markets. It's very tough to catch, as is the larger phenomenon of insider trading. Crackdowns like this, however, reflect well on the stock market's ability to self-regulate and should give investors comfort rather than trigger panic. So even if the mutual fund in question faces unwinding, the industry at large is definitely safer, and investors ought to remember that, like stocks, mutual funds should be carefully and closely examined before investing in them. Fighting inflation and food price rises. The government has again imposed a stockholding limit on wheat with immediate effect to bring down prices and check hoarding, says the Business Standard. The government has also assured that it's open to exploring all other options to bring down prices, including reviewing import duties, which are at about 40% right now, while the effective duty is almost 44% thanks to cesses and surcharges. A government official in a press conference said that there is no wheat shortage in India and the centre has adequate reserves to meet all requirements. Elsewhere, Reuters is reporting that India has bought a record 500,000 metric tons of sunflower oil for June delivery as competition between leading suppliers Russia and Ukraine made it cheaper than soy oil and palm oil, two leading buyers and a customs official told Reuters. In contrast, India on an average bought about 250,000 tons of sunflower oil every month in the last marketing year, mostly from the Black Sea region. Sun oil usually commands a premium of more than $100 per ton over soy oil and palm oil, according to a trader who spoke to Reuters. The industry will need time to refine and distribute those 500,000 tons, which will reduce imports in July. Traders told the Reuters again, India buys palm oil mainly from Indonesia, Malaysia, and Thailand, while it imports soy oil from Argentina, Brazil, and the United States. Low edible oil prices have been keeping food inflation lower than what it could be in India. To give you a sense, inflation in oils and fats is around a negative 6.7%, vegetables are at 27%, and pulses, which include dals, are around 17%. Again, latest figures. Among other macro news, meanwhile, India's current account deficit is at a surplus in the January to March quarter, largely thanks to higher service exports and private transfer receipts, the Reserve Bank of India said on Monday. The current account surplus stood at $5.7 billion in the fourth quarter of the fiscal year 23-24 compared to a deficit of about $8.7 billion in the preceding quarter, according to the Reserve Bank of India. In the same quarter last year, the deficit was about $1.3 billion. For the full fiscal year, the deficit, and it's a deficit, moderated to about $23.2 billion from $67 billion last year on the back of a lower merchandise trade deficit. Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. How fast are India's fast trains? Now, we all hear of the Vande Bharat trains, which can run at a top speed of 160 kilometers in some sectors. Now, running fast is not easy in India, by trains that is, as tracks are older and also get slowed down by multiple trains serving multiple destinations along the way for millions of Indians for whom trains are the only affordable and practical means of longer distance travel. Fast trains can, of course, speed up the economy as both goods and people could reach their destinations fast. Now, this is work in progress. To get a sense on where India's high-speed ambitions are presently, I spoke with Sudhanshu Mani, a former Indian Railways officer who is also considered the mastermind behind the Vande Bharat Express train. Mani apparently envisioned a self-propelled train that could run at a speed of 180 kilometers per hour and that would cost half the price of the imported semi-high-speed trains. I reached out to Mani, who served as general manager at Indian Railways Integral Coach Factory from August 2016 to December 18, and I began by asking him to define what high speed meant in the Indian context and where we were going in terms of projects and plans across India from his vantage point.
So high speed is a term loosely used, and there are various definitions ranging from speeds above 200 kilometers to above 250 kilometers per hour. I would place it more like at least above 220 kilometers per hour, which we would truly call high speed. Up to 220 kilometers per hour, what we have so far achieved is only trains tested at 180 kilometers per hour and commercially deployed to run at 160 kilometers per hour. And that too in a small section between Delhi and Agra. Vande Bharat Express, which was tested above 180 kilometers per hour, but commercially cleared to run at 160 kilometers per hour. And Gatiman Express, these are the two trains which run at that speed between Delhi and Agra. That's where we are. We are in the basically even 160 has not proliferated because the track has not been upgraded. Track upgradation requires certain track parameters to be improved, fencing of the tracks because the impact of any cattle getting run over is much higher on a higher speed. Improvement in overhead traction line also. And we have added here deployment of a more comprehensive signaling system with signals coming to the cab, whether it is Kavach system or something similar. That work is going on between Delhi and Mumbai and Delhi and Howrah to upgrade to 160 kilometers per hour. So it's anybody's guess when that would be completed. The target was completion last year. So at some point, maybe next year or next to next year, it should get ready. And then we'll have substantial kilometerage under 160 kilometers per hour, which is semi-high speed.
So at this point, just on the Vande Bharat, since that's the most visible manifestation of high speed, we have over 50 trains running or 50 train sets running. What does that mean then?
So it means that they are being run at suboptimal speed, not at the design speed. Because the acceleration, deceleration provision and other features are better than other trains, they are able to cut down travel time. But they are not being used to their full potential.
And what would you say is the average speed of, let's say, most Vande Bharat trains running elsewhere in India today?
So the highest average speed in India today is of the first Vande Bharat between Delhi and Varanasi, which is around 96 kilometers per hour. And otherwise, since it has been deployed in routes where it can only run at 110, the average speed ranges from around 70 to 96. Average, I don't know. Average would be more like between 80 and 90 kilometers per hour, somewhere.
Which seems good, I'm assuming, given maybe, let's say, the past. Or is there not much difference between what we've been doing in the past?
Oh, well, it is better than whatever was there in the past. But as I said, it's not being used to full potential. So approximately 10% improvement in average speed is what I can say.
Right. And the reason for this is because of, as you said, and signaling. And are there other reasons as well? For example, let's say,
mainly track and aligned, signaling, OHE, all that is aligned with track. Mainly track upgradation.
If we set, let's say, higher benchmarks for high-speed rail, now I have two kinds of questions. One is, what is realistically achievable? Secondly, does it really benefit commercially, and are passengers really asking for it?
Passengers look for two things. One is, of course, primarily cut down in travel time and comfort in the train. So the comfort part has been largely addressed. Cut down in travel time is not as per promise. In a distance of about, say, 500 kilometers, give or take 100 here and there, the time taken should be such that it becomes preferable to air travel. For example, Delhi Bhopal, if we can bring it down to, say, 4.5 hours, then the advantage air traffic has is lost, and people would prefer to travel in trains. So that's why right now there is good patronage because, first of all, air travel is more expensive. Comfort is already there. So in some routes, its occupancy level is very, very high. In some routes, not wherever, it's not even favorably competing with road. For example, Bhopal to Indore, Bhopal to Jabalpur, it's not favorably comparing even with road with higher fare. So it's not, the patronage is not good. specific to the current status. High speed, if I'm assuming it to be about 220, is a different ballgame. It requires dedicated track. I mean, you can theoretically go up to 250 in existing track, theoretically, but in India, my personal opinion, technical opinion is that we can aim to go maximum to 220 in the kind of track, alignment, curvature, and all that we have. So above that, to build a dedicated track. When you build a dedicated track, then you cannot have too many curvatures there, too many gradients, because these are the impediments to speedy travel. We have been debating about feasibility of high-speed train for India for decades and decades. And finally, in 2014, only this government decided to take the plunge between Ahmedabad and Mumbai with a Japanese assistance, technical as well as financial. Project is delayed because of various reasons, but as of now, it is back on rail, and I think it should be, as indications go, it should, 2029, we may have high-speed rail between Ahmedabad and Mumbai. The fastest train would perhaps take around 2 hours, 45 minutes. So you can see that this will totally kill air traffic, which is good because railways are much cleaner and much greener, much cheaper than air travel. We do need between certain cities such that you have good clientele. It competes with air travel and almost kills it. Nothing wrong in it. I can give you examples like Chennai, Bangalore, or maybe Delhi, Lucknow.
So the bullet train project is definitely a showpiece project as well in terms of technology, speed, excellence, and so on. Now, my larger question as well is, where are we in the larger quest for high-speed rail in real and practical terms? And how much of that is likely to, let's say, materialize in the next 5 years?
Only Mumbai, Ahmedabad is going to materialize, nothing else. You may hear a lot of noise here and there, but it's not going to happen. Even on existing track, I don't see signs that we would even reach 200 kilometers per hour in this time schedule. We can, but it doesn't look like it's going to happen. In these 5 years, couple more high-speed sections may get approved. Work may even start. Right now, the plan that India has made is rather exhaustive. It's covering cities all over. So, in my opinion, instead of that, we should choose 2 more sections. I gave you examples. And execute this work fast on these sections so that we have them run in, say, in a period 5 to 10 years. It can't be earlier than that. It can definitely be later if you don't execute properly. And then evaluate how good it is. It has proved itself to be a good mode of transport all over the world, except USA, which has transport and air lobby, and some other countries. All over Europe, it is the preferred mode of transport. And it's cleaner also. So in 5 years, we should be in a position that we may have 2 more sections sanctioned and work started, but actually completed only one, Mumbai.
Right. And last question. I mean, this, of course, is partly driven from perception. I mean, higher speed, does that mean compromise in safety in any way?
Not at all. I mean, you have safeguards. You have a lot of things which you have to take care of when you go to higher speeds. Those are technical details, but it imposes certain internationally acclaimed, accepted conditions in the train, in the track, in the signaling system, in the OHE, in every part of it. But the safety record on high-speed trains is better than on regular trains. So it does not compromise safety. Once you have taken care of the requirements, it is as safe or safer than regular train travel.
Right. That's a good note to end on. Mr. Mani, thank you so much for joining me.
Pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.